Welcome to our weekly market review. I'm joined again this week by Andre Celia. He's the currency strategist at Treasury One. Andre, another week, another robust data set out of the US. The PPI came out last week, and it really just reflects how sticky the inflation is.
Yes, good day to everybody. It's been sticky for 2.5 years now, and it's going to stay with us for a while. But the data that comes out of the US is mixed. And when you work with mixed data and you call yourself the Federal Reserve President, then or Federal Reserve Chairman, then you have a problem, because you have a inflation rate that you've set to be at 2%, and you are currently at 2.9%. And there's factors out there that could influence and swing inflation to the other side, upside, rather than the downside. And then you have to rely on data coming out. And we spoke last week and we said something about, if one looks at the manufacturing, money being thrown at arms manufacturing companies, that creates jobs and helps with the robust growth that we're still actually seeing in the US. Avoiding that recession that everybody speaks about. And that, coupled with the other mixed data signals, like, for instance, housing starts that came out, a record figure downwards, 35%, housing starts down. That tells you that the average consumer is not in such good shape. If one looks at the savings that was thrown at them, or money that went into savings thrown at them after the COVID situation, that's also dwindling. Not a heck of a lot of that's left. So your consumer remains under pressure, but then there's certain areas of the US economy that still does well. But nonetheless, if one looks, then the forecasts by most economists and the expectation by most banks simply says that they expect, in line with what Mr. Powell is saying, that we are just dialing back the lower rate situation for a little bit longer. And
because if the mixed bag,
carry on.
If the mixed bag of data is making it life difficult for the Fed, it's definitely making life difficult for the traders who trying to pinpoint when that first rate is going to come.
Well, I think sometimes the traders make it difficult for themselves. I said last week to somebody else that if you look at what markets are doing, and those are the market participants, the market economists, and then they come out with these fantastic expectations. When it's non-farm payrolls, they expect a certain figure. When it's inflation, they expect a certain figure. And if you look at now, last week when they expected the inflation rate, they were forecasting at 2.9%, and it came out at 3.1%. And then they disappointed with that. But the 3.1% is 0.3% lower than the previous month, and the previous month was 0.3% lower than the month before that. So it is on a downward trajectory. Now, do you want to see these massive jumps continuously, or do you want to see a consistent downward trend? In my opinion, the consistent downward trend is the better one. Then, if you listen to what Mr. Powell is saying, and that I'm saying to the market, he's been on this rhetoric situation of longer, higher for longer, and we will be data dependent. So stick with the plan. He said data dependent. He said longer for higher interest rates.
That's where we are.
Now the market, if you look at what they're now expecting, now they say we may be expected only in the second half or towards the end of the second half. So being in the middle of February already, maybe we should just put March out of our minds and just focus on what is actually being said.
just calm down a little bit. So I'd like to move from the US to a country who's seemingly having an opposite problem at the moment. The China is struggling to reverse its deflation trend. It's also struggling to get its economy back on track. And last week, the Chinese authorities decided to keep interest rates on hold. And Andrea, I'm interested to know what you think of whether this might be a wait-and-see approach by authorities to see the impact of other stimulus measures that it's implemented in the economy, what the results of that will be before they decide to move.
Yes, if we look at the Chinese economy, then they've been battling for a heck of a long time. They are still showing good growth, but it's not the 7 and 8% that we've always seen. Mm-hmm. But now we must, there was a lot of factors driving that 7 and 8%, and those factors are not there anymore. Then it came COVID. They took a lot longer to come out of the COVID situation. Some of the measures that they have during COVID was a lot stronger and stringent than in the rest of the world. And slowly they are coming out of it. But in that period, what was highlighted out of the Chinese economy was a massive problem in the housing and construction sector. And that's still with us. Now, lower interest rates obviously helps that, but you need robust growth to really save that construction sector. And that's not what they're seeing. But at the same time, you can't continuously stimulate. And I think, if we just look at our own central bank president, Mr. Kanyaku, had said several times to our market that it is not the job of a central bank to stimulate economic growth. The central bank has got other factors that they need to keep in mind. And here, with China keeping their interest rates at the same level, not changing it, I think the focus swings more to protecting their currency from further and a lot of devaluation. And as I say, it's not their job to actually stimulate economic growth.
That's right. I just want to quickly move us to domestic soil. Enoch Godongwana will be in the hot seat on Wednesday, the finance minister, delivering the all-important budget. And I've said this morning as well. It feels to me like the past 6 to 10 years, every budget we go into is like, this is it. This is the watershed budget. And again, we're here, and I feel like I'm saying it again. This is the watershed budget. And I don't think there's going to be many surprises. I do expect to see our debt breaching that 80% to GDP level in the coming years, and that will reflect in the forecast, which we did not see in the last MTBBS. I don't know what your take is. What are some of the points that you will be looking out for and expecting coming out from the budget on Wednesday?
Yes, I'm smiling because, in what you've said, it takes me back to the 90s and the 80s and the 2000s and the whatever. And all finance ministers always tell you, it's going to go, it's going to be worse before it gets better. And hence, that saying or that feeling that you have every year is the same thing. But this year, I think there's a lot of fires under the seat of Mr. Godongwana, and it's certainly a hot seat. We know that we don't have money. We know that we've overspent. We know that on our revenue side, we're not collecting enough. We know what the problems is there. We know it's because the mining houses do not pay a lot of tax because they're not exporting that much as they should be because Transnet cannot get the goods to the harbors. We also know that most probably from the bank side, their tax is a little bit lower because their provisions for bad debt is quite a lot higher because the consumer is under a lot of pressure because interest rates is a lot higher. And there's just not money. And we need money for economic growth, and we need to get our SOEs going. So we have to look at their debt and their sustainability. At the same time, our municipalities throughout the country is falling apart. So allocations from government to municipalities and local government would most probably have to be re-looked at. So Mr. Godongwana has a lot of askers and very few givers. And we'll see how we budget it. But there is something that we'll have to look at how that one plays out. And we know that there's been a lot of talk about our unrealized profits on our gold and foreign exchange reserves. Money that belongs to the Treasury. It's just actually how you get that money out of unrealized profits into realized profits and being made available for the Treasury. So let's see that space, how he's handling that, because that could be the little dove that he pulls out of the hat to make things look better. But then we'll have to see how firmly he keeps his hand on spending and how he raises that majestical 15 billion rand additional on the income side.
Yeah, and it is an election year, so, it is a bit of a hot potato for the ANC-led government. Like I said earlier, we're not expecting any surprises really to come out of the budget. They don't have much wiggle room, but is this still causing some uncertainty for the rand for the week?
I think it could cause some uncertainty, but last week when we spoke, we set down the trading range 1860, 1920. And I think what we could see this week is closer to the 1920, maybe slightly breaching it. But a lot of it still revolves around how volatile the dollar will be against other major currencies. So, and also around the budget, a lot will revolve on the comments coming out after the budget, and that could be not immediately after, but 2, 3, 4, 5 days in a week after, especially from ratings agencies. What can be expected from that? So I think the rand is still very happy in the 1860, 1920, but for the next week or so, we might be on the upper end of it, slightly breaching the 1920, but then coming back into that trading range, 1860, 1920. What is it that the people out there should be doing? I think if I was an exporter and I see it closer to the 1920 level, I would certainly look at taking some hedging and protect myself against further strength. Or strength after that. And if it goes to the 1860 or slightly below that, then as an importer, I would also protect myself in the near term. Because why do I speak about the near term for the importer and the longer term for the exporter? Going back to the start that we said, is that probability of a weaker dollar in the second half that could benefit the rand. And so hence, longer term for the exporter, shorter term for the importer. But I'm happy with the range.
Andre, thank you very much for sharing your insights. You and myself will catch up post-panel budget. It's happening on Thursday after the budget happening. That will be scheduled for Wednesday, of course. So we will catch up with you then. And then next week, Monday, I'm sure we will be highlighting some of the hot potatoes that Godongwana is going to share with us.
Good week for you. Thank you, Ilse Marie.